Hey there, beautiful people. Welcome to Real Talk and Due Diligence and Penalties. I'm your host today, TamikaMarie, and we're going to jump right into the most important part of doing taxes. I like to call this the CYA, also known as Cover Your Ass. I've broken this down into two parts, and I'll show you how in the last 20 years, I personally have been able to avoid preparer audits, 6199 and 622 letters. So let's jump right into this. All right. So, as we dive into the tax game, I'm here to guide you through how I smiled the last 20 years of wisdom and backing every word from how to avoid getting a preparer audit. We're going to tackle this head on, no sugarcoating, because when it comes to preparer audits, it's serious business. So here's the real deal on what we're going to cover: professional responsibility, what it means to practice before the IRS, recognizing yourself as a true tax practitioner, and the difference between enrolled and unenrolled agents. So let me get you armed and ready to face the IRS with confidence and smarts. So here's to empowering your financial ability with a little bit of Tamika effect. So, our module goal is to navigate ethical tax preparation, and the heart of ethical tax preparation is Circular 230, the definitive guide that ensures fairness, accuracy, and integrity in our tax dealings. So, as your guide, my role is to help us navigate these guidelines and ensuring that our approach is not only compliant, but ethically sound. So, in this class session, we're going to be focusing on understanding the process of a tax return, taxpayer rights, and tax pro ethical standards, as it's our responsibility and how we must adhere to this under Circular 230. It's all about keeping things straight, honest, and professional. So let's get you equipped with the knowledge to make informed decisions. All right, so morals and ethics is the core of what we do. These aren't just highfalutin sounding words, they are what drive us every day. Morals are about the collective sense of right and wrong, the do's and don'ts that society agrees on, like always telling the truth. Where ethics, though, is where we get personal. It's about the choices we make and how we apply those moral principles to real life situations. It's deciding when and how to speak the truth, especially in tricky scenarios. This is where we stand firm, making sure every decision aligns with both our personal integrity and the broader standards that we have to uphold in this career path. So let's dive in and explore how these principles guide us in the tax world. One of the most important forms is Form 8867, known as the Paid Preparers Due Diligence Checklist. This serves a crucial role in tax preparation, particularly when dealing with specific tax credits. Here's the breakdown of its purpose. For starters, Form 8867 is designed to ensure tax preparers adhere to due diligence. When claiming credits like Earned Income, EIC, the American Opportunity Tax Credit, the AOTC, Child Tax Credit, the CTC, and the Head of Household Filing Status, also known as HOH, for their clients. The form requires preparers to confirm that they have used correct information from the taxpayer or other reliable sources for the tax year in question. You must also assess the documents, the taxpayer's eligibility for claim credits, and the HOH filing status included in the interview process, and you have to review any relevant information. Okay, so hold on to that. So, as a preparer, you must address any inconsistencies and information provided in any documentation requires in inquiries made to resolve these issues. So, basically, it's saying that you got to ask questions. We can't be timid about this. The form also mandates that the retention of specific records for 3 years, including a copy of Form 8867, I'm going to say this again, all of the applicable worksheets and documentation provided by the taxpayer that were relied upon in determining the eligibility of the credits and the amounts. We also have to include questions about whether the taxpayer can provide documentation to substantiate the eligibility for the credits of head of household if audited. So that's part of the gray area. So hold on to that gray area too. I want you guys to write that down, gray area. And finally, the preparer must certify that the answers on the form are, to the best of their knowledge, true, correct, and complete. True, correct, and complete. In essence, Form 8867 is a critical tool for tax preparers to ensure that they meet the IRS due diligence requirements, thereby safeguarding both themselves and their taxpayers. All right. So when you do the 8867, this is the form that the IRS is going to pull, and they're going to match up this information. If the information that they request during a taxpayer audit cannot be substantiated, and this happens enough, this is how you trigger a tax pro audit. All right. So, due diligence is our commitment to accuracy and integrity. When it comes to due diligence, the IRS sets the bar very high, and it's for a good reason. If you're claiming certain credits or filing head of household, it's my job as the tax professional to deep dive. This means asking the right questions and gathering the necessary documentation to ensure that you're getting credit for the tax benefits that you rightly deserve. Performing due diligence is a critical part of our journey, whether we're dealing with refundable credits or not. So it doesn't make a difference if the credit is triggering a refund or even a deduction in their tax liability. You still have to make sure that they are qualified to be able to receive access to those credits. So make sure that you are filling out Form 8867 with the utmost of precision and care, because that's where you're going to get caught up. So it's no secret the IRS loves records. They deal in paperwork only. So for the next 3 years, for the next 3 years for the IRS, and 5 years, right? For some of our security and insurance protocols, we need to keep the following: a copy of Form 8867 and any worksheets used, copies of documentation to prove your eligibility to claim those credits, details of where, when, and from whom you got your information, notes on any additional information used to determine the eligibility. So as your tax pro, this is like your diary that you keep on each client to prove to the IRS that you asked the hard questions to determine that your client was eligible to claim the credit and deductions. And the IRS will process this tax return based on your position. Take a moment and write down the word position. We're going to come back to that. Always remember that you have liability here as well. So in the tax game, due diligence is where the IRS draws a hard line. And trust me, they do not play around. When you're looking to claim credits or file head of household for your client, make sure that you do the heavy lifting. We're talking about getting down to the nitty gritty and asking those key questions and pulling together all of the right paperwork to make sure that you're getting every tax benefit that your client is entitled to. This due diligence thing, it's more than just an in-step process. It's a crucial part of the journey together. Whether you're navigating through refundable credits or something else, it's all about being meticulous and taking notes. We're going to ask you the deep questions. You have to get in these people's business. Now, let's be clear. You don't always have to have all of the documentation present, but you have to ask, can you provide this documentation to the IRS in the event that you were audited? And you have to notate that you asked this question, and you have to notate if they said yes, no, and move forward from there. So Form 8867, you have to fill that out with the kind of attention to detail that it exactly demands. It's all about accuracy and integrity and making sure that you're staying on point. All right, so 6 crucial components in the due diligence compass. 1, common sense standards. We all know that common sense isn't common, but in the tax world, as a tax pro, it is your job to shift through all the details. Does everything add up? Are there any gaps or red flags waving in front of us? Make sure that you take notes of it all, right? You have to do a complete information check. It's like a fact checker on the mission. If there's something missing or it feels off, trust me, you need to dig deeper and make sure that you get the full uncut picture to make sure that you're on the right track and providing your client with the highest level of credits and deductions that they qualify for, but also making sure that you stay within those realms of CYA. You also need to do a consistency check. So this is your quality control. You need to be scanning for any inconsistencies in the info. Are things matching up, and are they going to straighten out? If you get a client that tells you that they have 3 kids and that they work, if there isn't dependent care credit, then who keeps the children during the day? If someone else is working, who makes more money? If the other parent is working, and if both parents are working and they're not filing together, whoever makes more money technically is who should be filing those children if they all meet the relationship and the residency test, right? So you have to make sure that you ask the questions that trigger any opposing answers that won't match up in your due diligence. And then, so you want to do in-depth interviews. Picture this as your annual checkup. Just because you did someone's taxes the year before and they met all of the information for the credits, all of those, right, those relationship, residency, and income tests, doesn't mean that their situation hasn't changed from year to year. So every year requires an in-depth interview. You're going to dive deep into their financials and make sure that you catch any changes, right? Some people get a raise, some people lose a job. What they qualified for last year, maybe they exceeded the income and they priced out, their income bracket, priced them out of being able to receive the EIC. But if they lost their job or something unfortunate happened and they went on disability, now they actually can't qualify for those credits. So we never want to make any assumptions, right? You want to do a detailed questioning. Expect a lot of questions. Make sure that you write down all of the questions that you find that are pertinent. If you need some assistance with determining exactly what questions you should be asking in the due diligence, take a look at our store. We do have all of the due diligence forms that are available for you to be able to purchase, and they can even be branded for you, or branded for your team, for you to be able to make sure that you are conducting in-depth interviews. You want to nail them down every time, and it's all about hitting that accuracy mark. And then document everything. I'm docking conversations like I am a historian. It's not just about keeping records, it's making sure that if you're having a verbal conversation, that you write down all of that information. And I personally, depending upon what software that you're in, you can make those notations directly. If you've got a CRM, you can make those notations directly in the CRM, but you need to have this down in writing somewhere that you ask these questions and here's what the response was. If you're using TaxSlayer, then you can actually add all of those particular notes in the miscellaneous notes section. And it does save with that return so that you can always go back and access it. Unlike Taxes to Go, where some of that information disappears, but that's a conversation for another day. Alrighty, so frequent errors, qualifying child errors. It's really, really super easy to sloop up here. Claiming the earned income credit for a child who doesn't actually qualify is a big no-no, right? Filing status mistakes. If you're filing as head of household or single, when you're actually married, that's a red flag for the IRS. They will come and snatch you up. Income and expense misreports. Underreporting your income, the IRS gets a copy and they know exactly how much money you made from whom, when, and where. So if your client's trying to file early without including a W-2, if they are not including, maybe they had some discretionary income, maybe they traded in stocks and bonds and they're supposed to trigger a Schedule D and they didn't provide that information for you, not only is it going to hold up the return, but if this happens on a consistent basis, guess what we're triggering? A due diligence error audit, because you're not asking all of the correct questions to make sure that your client has that you have a clear picture of what your client is supposed to be providing for you. You need every last TOTS document before you hit that send button. Not to mention, if someone underreports their income and you triggered a refund for them, when the IRS comes back and says that they owe money, let me tell you how unethical it is to come up with additional expenses to be able to zero that out. You don't want to play with these people. Trust me. Alrighty, so let's talk about the consequences. What happens when we make these types of mistakes? Clients, they got to pay back with interest. If there's an error, your client may have to pay back the incorrect amount plus interest and penalties. Now, it's not just interest, right? Form 8862, filing your client may also need to file this form for up to a decade if there's an error. It's a bit like being on the IRS watch list. It's also important to note that if you get a reject with a request to file an 8862, then that means that your client previously misrepresented some of their information to be able to qualify for a credit that they really didn't qualify for. So you had better make damn good notes about this client before you resubmit and attach that 8862. Make sure you got all your ducks in a row, your I's dotted, and your T's crossed, okay? There's also an EIC ban. If this mistake was due to carelessness or intentional rule breaking, your client could be barred from claiming the EIC from anywhere from 2 to 10 years. It's like being in a total penalty box, okay? So if you're getting any of these types of errors when you're dealing with the client, again, make sure that you have all of your information documented, because the last thing that you want to do is trigger a tax pro audit, because it can also open up your other clientele to get audited, okay? Now, the IRS, they got really cute. If you as a preparer don't meet these due diligence requirements, the IRS got really cute in 2023 and rolled out some penalties that we have never seen before. So we've always faced the following. We could lose our credentials. If a tax preparer messes up big time, they could lose their official status as a tax preparer. We can be kicked out of the e-file program, where they said we can't play in the sandbox no more, right? They'll suspend our e-fin and they'll basically kick us out of the program, and we cannot go and get another one because now we are no longer eligible to pass the suitability test. Then there are also disciplinary actions from the OPR, all right? So the Office of Professional Responsibility might step in, and then there's legal restrictions. In some cases, you might end up going to court and they will step in and say you are not allowed to prepare taxes anymore. Where I've seen people that were barred for 10 years, I've seen people that were barred indefinitely, and then they had to pay back restitution. And then there's also employer penalties. So, if you are a service bureau or an ERO and you have tax pros that are working under you, if a preparer working for your company doesn't do their due diligence, you, as the ERO, could face penalties from the IRS unless you can prove that this was a rogue employee. And the only way that you can prove that is by showing that you have done everything within your due diligence to educate your team and that they knew without a shadow of a doubt that what they were doing was firmly and solidly against the law. So it's very important that you make sure that you educate your team that is working under you as a P10. All right. So now let's chat about this new fine and penalty structure because it's a doozy. All right. So the IRS has set strict penalties for tax preparers who don't follow the tax laws and regulations. I'm going to give you guys a quick overview at what's at stake for preparers who are slipping up, right? So, number one, understatement of taxpayers' liability. For unreasonable positions, remember I told you to hold that word because it's coming up and it's going to be good. For unreasonable positions, the penalty is $1,000 or 50% of the preparer's income from the return or claim, whichever is greater. For willful reckless conduct, it's $5,000 or 75% of the preparer's income from the return or claim, whichever is greater. Other accessible penalties: failure to furnish a copy of the tax return to the taxpayer is $50, right? With a maximum annual penalty ranging between $27,000 to $30,000 depending on the year. Failure to sign a tax return. This is for you ghost preparers. $50 per failure with a similar maximum annual penalty between 27 and 30K. All right. Failure to furnish an identifying number. This is if you're leaving your P10 off of their return. Again, it's $50 per failure with the same maximum limits, 27 to 30K. Failure to retain a copy or list is $50 per failure. So let's add this up. If you had 100 clients and it's $50 per client, you can see how this is quickly going to get expensive. So you have to keep a running log of who you serviced, what happened with that tax return, what information that they provided you with, a copy of the 8867, a copy of the 7216. So you see where this list of prepare documents that are required is getting long. All right. So this is why a CRM is very, very highly important because you have to be extremely organized with this. Okay. Now, that $50 failure with the same maximum limits. All right. So, negotiation of check penalties. So, if you are caught as a tax preparer trying to deposit and/or cash a check that was supposed to go to a client, the penalties range from $545 to $600 per violation. And at this time, it's not listed to have a cap. All right. Failure to be diligent and determine eligibility for certain credits for tax benefits. Penalties also range from $545 to $600 per failure, no cap. Promoting abusive tax shelters, which means that you know for a fact that your client is not eligible for this tax shelter, but you're doing it to be able to reduce their income, not necessarily triggering a refund, but you're trying to hide their money. All right. So false statements about tax benefits, 50% of the gross income made from the activity, providing a gross valuation overstatement, $1,000 or 100% of the gross income from the activity, whichever is less. Understatement of tax liability. So if you are putting Schedule Cs on W-2s that have nothing but losses in income, that's an idea of understatement of tax liability. It's a $1,000 penalty, $10,000 for corporate tax returns for aiding in the underestimating of a person's tax liability. Disclosure of use information by preparers, $250 for each unauthorized disclosure or use with a maximum penalty of $10,000 per year or $50,000 in connected to identity theft. So um, scammers, we know that they exist. We know that you have to particularly vet anyone who's going to come and work, particularly office staff, secretaries, and things of that nature. Them having access to someone's personal identity information, your WISP plan has to ensure that you are taking the required steps in order to make sure that you're safeguarding your client's information. So this is why the WISP plan exists. You have to have a security plan on how you would notate to someone that their identity has properly been compromised. You also want to make sure that you're background checking anyone who's going to be working with you. And then if you guys are having P10 preparers and they're all under one EFIN, you also want to make sure that you're checking that box on the back end that says that they only have access to their clients and not the entire scope of everyone that's going to be put into your system if you're dealing with multiple P10 preparers. All right. Fraud and false statements. This is a felony crime with fines up to $100,000 or $500,000 for corporations and imprisonment of up to 3 years. The thing about this fraud and false statements, it's very broad. Okay. It's very broad. Remember, we talked about those gray areas. So, just like you have gray areas on the positions that you can take on the tax return, fraud and false statements is pretty much encompassing everything. If you tell one lie, you told them all, and they can get you under this statute, period. Imprisonment of up to 3 years. So, I know we get like a little jelly and a little cute up under the, and we like, y'all going to jail, and you know what I mean, taxpayers, tax pros telling other tax pros, oh, you're going to go to jail if you're going to do this. But this is actually something that is it's happening. And it used to take 5-10 years for the IRS to catch up to a rogue preparer, you know what I mean, to find people. But if you've been looking in the news and if you subscribe to the tax pro criminal justice page, you see that they're getting people from 17, 18, they catching people from 19. They're not too far behind. So trust me, baby, they're on your heels. Okay. Fraudulent return statements and other documents. If you are creating documentation for people to file returns fraudulently, so catch the statements and other documents. This is a misdemeanor crime that can lead to fines up to $10,000, $50,000 for corporations, and up to 1 year of imprisonment. Okay. So if it's cheaper for a client who has an LLC to all of a sudden become an S corp, but you don't set that S corp up correctly, take that, change the filing that's necessary for them, also do the payroll and all of that good stuff. Guess what? Fraudulent returns and other statements and documents. And because that is a corporation, it's not $10,000. Now it's $50,000. So make sure that you are doing the due diligence, because this also comes with the fine of imprisonment up to 1 year. Don't nobody want to sit in jail for 1 year because you filed a 2553. We're not doing that around here. Okay. So knowing or reckless disclosure of use of information. Fines up to $1,000 in imprisonment for 1 year up to each use of unauthorized disclosure. Okay, so let me give you an example of this. I've got a sister company that does credit repair. So when I do people's taxes, I actually kind of link it together. But I have to have them sign off on that, because even though I'm the same person that's in each one of those businesses, just because it's something that I offer, I can't automatically put them into my credit repair system, right? So I have to tell them how I'm going to use their information in whatever it is that I'm going to allow them to do. So make sure that you sign off. If you're offering other perks and other incentives for someone to come into your business, make sure that your engagement letter states all of that information and that they're reading it and that they're checking off and being party to be able to participate, because that is you sharing their information. And if it's not included in your engagement letter, then it's not covered in your WIS plan and you can get in trouble. All right. Okay, so these penalties highlight the importance of accuracy, honesty, and adherence to the law in tax preparation. It's a reminder that as tax preparers, we need to be diligent and responsible to avoid serious consequences. This is a catch-all for what our industry calls kitchen sink or ghost preparers, and they coming for y'all, and they mad about it. So let's make sure that as tax practitioners, we CYA, because that's the name of this game. All right. So, age requirements, primary errors for CTC, ACTC, and ODC. Age requirement slip ups. Claiming CTC for a kid who is too old is like trying to, get a child ticket for a teenager. We can't do that. Dependency requirements, mistakes. If the kid is actually dependent on you, claim the CTC is a no-go. If you're not taking care of this kid, so say for example, I've heard situations where the the other parent, we're not going to say mom or dad, we're going to say the non-custodial parent is the person that's actually claiming the child, but they haven't done anything for them. They don't pay any child support. They don't live with this person. They're not providing any type of monetarily support. It doesn't make a difference how much they make. They don't meet the support test, right? So just because someone makes more money doesn't always mean that they're the person that's supposed to be claiming the child, because they still have to be able to meet that support test. That's a no-go. It's a no-go. If someone's parent took care of, like the grandparent is the person that actually provided for the child, then the grandparent would be the person that would be eligible to claim that child. It's not de facto just because of to the biological parent because they made more money if the support test isn't met. All right. So residency requirements. The kid needs to have lived with that person for more than half the year. It's not just about being family. It's about literally where they lay their head. And then the income-based reductions. Some credits shrink as your income goes up. It's like getting a smaller slice of the cake, but you already had the dinner. You made your money during the year. So keep in mind that these credits are refundable and it's to benefit low income people. So that's why sometimes you get people that come in and play poor. We can't do that. All right, so here's a big one. And I've been seeing this floating around the internet a lot this year where it's like, oh yeah, how much are you getting for, one single person? And people are like, well, if you add if you add AOTC, then that boosts it up by $1,000. Baby, what is you doing? Let me tell you why this is not cool. Okay. So, claiming AOTC for a student not in an eligible school. So, just because you go to a school does not mean that your school is eligible. It's like using a gym membership at a place where you are not a member. Baby, they gonna snatch you. That's one of the credits that, let's see, I can say probably back as far as like 2012, 2013. That's one of the credits that they snatch you up for the most, because if you're not triggering a 1098T, then if that document is missing, it's very easy to tell that you were not participating in an eligible school program in order for you to qualify for that credit. So, I know back in the day, like for example, I provide tax classes. Some of these are paid, but you can't claim that on your taxes. It's not something that's going to be eligible. All right. So expense reporting. If the student didn't actually pay qualifying expenses, claiming the AOTC, it's off limits. And we know, yeah, it's going to boost your refund, but are you willing to take a hit for the few bucks? Like, let's be real. You could be losing your license, your ability, excuse me, not license. You can be losing your ability to practice as a tax practitioner just because somebody wanted to have a few extra bucks. And not only that, they're going to have to pay it back. And guess who they're going to be looking for? You. So you have to make sure that you're making clear and concise notes on exactly what happens as you're going through. No 1098T, no AOTC. All right, so another good one is determining who qualifies for HOH. Now, what's really funny is that sometimes it can literally be the difference between a couple $100s on who qualifies for what. So you have to also ask yourself what's going to be the most advantageous position for yourself and your client. All right, so unmarried, right, which would be single. To qualify, you need to be to be part of the head of household. First, you have to be unmarried. You have to be considered unmarried on the last day of the tax year. This means that you were either single, divorced, legally separated, and been living apart from your spouse for the last 6 months. Your ex living in the basement does not count. Y'all still in the same house. All right. Home sharing requirements. You must have had a qualifying child or relative who lived with you for more than half the year. This is a key factor in establishing your eligibility for head of household. If you live by yourself, you do not qualify. Two people, now I've said this before, two people can both qualify to be head of household in the same residence as long as the support, residency, and relationship tests are all met and they do not have the children being claimed in common. All right. So I've got some rules up on my page that further go into detail that explains how this happens. But basically, it boils down to this. You've got parent A and you've got parent B. All right. Parent A has a child from a previous relationship. Parent B has a child from a previous relationship. Or maybe parent B has the child from the relationship in common. Parent A makes less money than parent B. Okay. I say parent B makes more money than parent A. So parent A is going to claim their child from the previous relationship, and parent B is going to claim the child that they have in common, or if they have a child from a previous relationship as well. These are two people who split their bills. They both qualify as meeting the support test and providing over half of the support for their each individual relationship test dependent. All right. So that's how that happens. Or in another case, it could be dependents, right? Excuse me, roommates. Two roommates that have no children that are in common, that split the bills equally, that both work, could meet the support, residency, and relationship tests in order for them to both be able to file head of household. So those are two examples in where that can actually work for someone. All right. So special cases for divorced or separated parents. If you're divorced or separated, the child can be claimed based on where they spend most of their time. Typically, the parent with whom the child lives with for the greater part of the year is who gets to claim head of household status. Then you also have to think about financial contribution. You must have paid for more than half of the upkeep of your home during the year. This includes rent, mortgage, utilities, groceries, and other household expenses, which would include your own personal bills. So say you're splitting your bills 50% down the middle, but let's talk about car note. Let's talk about insurance. Let's talk about health insurance. Let's talk about credit card bills and other debt. Those are all parts of the upkeep of your home. So even though you're splitting the bills 50-50, if you have your own personal bills, then that is over more than half for your upkeep for your home. Am I making sense? Y'all picking up what I'm putting down? All right. So again, this is a position. So I know you guys wrote that down in your notes. We get into it, I promise. So then proof of residency. To substantiate where the child lives, you can use the records from school, medical facilities, daycare centers, or social services. If you're using school records, they should be official and include a photo of the child. These documents are crucial in proving the child's residency, which is a vital component in head of household. Now, after COVID, everyone got the ability to be able to log into their school's student panel, right? Whether it's like Canvas or something of that nature, where everyone can log in and you can have access to where your kid goes to school. You can see their grades. And right over there in that little corner on your Canvas, it has a copy of their picture. That's all we need. That's all we need in order to show that the kid, you're the primary person, because it's going to have your information and your agent profile about who is your child and who's up under you. That's proof of residency, that is good enough for us, right? All right. So remember, accurately determining your client's head of household status is crucial, and it can significantly impact their tax liabilities. I've seen it be the difference of a couple of $100. I've seen it be the difference in like $1,700. It just depends on someone's unique situation, exactly what it is they're going to qualify for. And as a tax professional, if you have any doubts, ask more questions. Alrighty. It's also crucial, so crucial, to verify self-employment, because people will come up with all type of businesses that they have, especially when they need to be able to reduce their income. So key indicators of trying to see if someone is not being all above board is if they have a W-2 and they underreported in taxes, then you want to make sure that you CYA and get all of the information that you need to substantiate their self-employment, particularly if they took a loss or a large loss on the business. All right. So tax pros need to make sure that their clients are actually running a business, because after 4 years of reporting a loss, the IRS will kick it back and be like, this is a hobby, sis. You ain't making no money. So you want to make sure that you're checking all of the records. Do they have all of the paperwork to back up the income and expenses? If some records are missing, can you piece together the missing info? It's also important to note that this is bookkeeping. This is not tax preparation, and it should be billed as such. If you're reconstructing documentation, make sure that the person understands that you're helping them with their self-employment stuff. That's bookkeeping. That's a different charge. Income and expense reporting. They have to report all of the money that they made and spent on their business. It is highly unethical to add expenses to underreported income on an amendment, and that's the quickest way for you to get a 6199 letter. Don't fall for the okie doke, okay? So navigating the tax complexities of tax credits and filing statuses require attention to detail and a thorough understanding of the IRS code and rules. So as your instructor, I'm here to guide you through these intricacies and ensuring that you avoid common errors and stay compliant at all times. That's just the name of the game, CYA. One thing's for certain and two things for sure. Determining head of household status is a crucial part of filing taxes, and it's important to understand the criterion thoroughly, right? So one, you have to be unmarried. Two, you have the home sharing requirement. Three, you've got the special cases for divorces. Four, you've got your financial contribution. Five, you got your proof of residency. And then you got to make sure that everyone that is filing for head of household is qualified to file for head of household, and that you notate all of this information, plus any questions that you ask, plus any discrepancies, plus any documentation that was provided to support your client's stance is also notated in your notes. And then you have to have copies of all of that documentation as well. All right. So dealing with the IRS and navigating all of their information is extremely complex. And as a tax professional, it's crucial that your client understands their rights in this space. So here's a straightforward breakdown, right? Your client has the right to clear information. They're entitled to explanations that are straightforward and easy to understand, free from confusing tax jargon. Now, anyone who's called the IRS know that that's almost impossible, but they put it in the Bill of Rights. They also have the right to quality service. They can expect and demand service from the IRS that is prompt, respectful, and professional, just like you would from any other reputable service provider. They probably don't know that they be hanging up in our faces, but if you go in, they're equally as mean. They also have the right to pay only what they owe. It's your job to ensure that your clients pay exactly what's due and not a penny more. It's about accuracy to what's owed to the government. One of the things that I always caution when I'm giving out this Bill of Rights to my people is like, it's my job to actually make sure that you're not getting a refund. My job is to make sure properly, as a tax practitioner and a tax strategist, my job is actually to make sure that you get to keep your money during the year and invest it properly so that your money is working for you. But that's a whole nother topic for a different day. But we want to make sure that they're not paying more than what they owe, right? So of course, there are going to be some credits that are triggered if they're in a certain income bracket, but ideally you want to zero. The goal is to zero us out here, right? Your client also has the right to challenge the IRS. If a taxpayer disagrees with an IRS assessment, they have the full right to question, contest it as much as they like, and seek clarification on those charges. And if they cannot be explained, then they can escalate it as far up as they can go to the tax court. All right. So, should you find the IRS decision is unsatisfactory, you have the option to appeal, akin to seeking a second opinion in any critical matter. And they also have the right to closure. Once a tax issue is resolved, the taxpayer has the right to expect it to be fully closed. So they're not going to come back and say, oh, we forgot about XYZ. Once it's over, right? And then taxpayers also have the right to privacy. Any tax examination should be seen as unobtrusive as necessary, respecting the taxpayer's privacy and their boundaries, which means that they're not going to be calling them like a debt collector at night. The IRS only communicates through letters, period, which is why it is so important that when you're doing your due diligence, that you always make sure that you have your client's current address and current information, so that any communication could reach them in a good time manner, right? They have the right to keep their data safe. Their personal and financial information must be kept confidential, secure, and treated with the utmost care and trust. And they also have the right of representation. They have the option to choose someone to represent them in their dealings with the IRS, ensuring the best possible advocacy and report. They have the right to a fair system. They have the right to expect that the system operates fairly and justly, regardless of personal and financial statuses. This basically means that just because someone is a woman, that they would be taxed at a lower rate than someone who is a man, or something of that nature, or that they would be treated differently based on whatever their EOD status is. Is it EOD? Their economic, race, creed, sex, all that good stuff. My ADH is DN and all of that. It's literally our job to help our client understand these rights that are key in navigating the landscape of tax professionally and effectively, and ensuring the best outcomes for your clients. As a tax professional, it's our duty to be well versed in the rights of advocacy and to effectively advocate for our client and uphold their rights to the strongest of our ability. All right, so Circular 230, protecting rights and responsibilities. Circular 230 is the constitution for tax professionals. It sets the standard for ethical and responsible behavior in tax practice, safeguarding both your rights as a tax pro and their rights as a tax preparer. So here we go, gray areas. So tax preparation isn't always black and white. Sometimes there are gray areas that need very careful navigation. Your job is to steer through these ambiguities, always keeping you and your client's best interest in mind. So let's break down what taking a position means, right, on a tax return. So one, tax return position. If you, as a tax professional, advise a client on their tax return to make a call based on all the facts that you know, this isn't just filling out forms. It's about making informed decisions on how to report something on a tax return. When you recommend a tax return position, you're essentially advocating for your client. You're making sure that their tax situation is presented in the best possible light within the bounds of the law. You've got to stick to these set standards by the taxing authorities. But if there's no clear standard for your tax position and you need a solid good faith belief that the position could be held up if challenged, it's a little bit shaky, right? You should advise your client to disclose the position to avoid potential penalties. So again, let me read that for you guys again. So this is the standard compliance. You've got to stick to the standards set by the taxing authorities. If there's no clear standard for a tax position, you need a solid good faith belief that the position that you chose could hold up if challenged. So if the IRS comes back and says, hey, you took this position in regards to someone filing head of household status, but there was someone else that was in that house that also filed head of household status. You explained the position that you took, yes, but these people were roommates. They did not have a child in common, and they both paid their set amount of bills plus their own personal bills, and their children were registered to them. They met the support test. They met the relationship test. They met the income test, everything, the residency test, everything was right. So you hold that position and the IRS can rule in your favor. That's just how that goes. Now, it's a bit shaky when you're getting into other case law. So it's very important that when you're holding positions that you look up what happened previously, and how the court has swayed previously is generally how they're going to continue to rule. And you can just set that case law. You can cite that case law when holding your position. All right. So penalty advice. Part of your job is to let your clients know about any risk, including possible penalties for the tax position that they take. It's about being upfront and helping them understand the consequences. So it's like, hey, So you can qualify to file head of household, right? Because you're in a roommate situation. But if they disallow, this is the difference in the amount of money that you would owe. This is the possibility of any penalties. Would you like to proceed? And if they say yes, I want to make sure I get that extra $1,700 because I know for a fact that I was the head of household in my portion of the home. No problem. We're going to go ahead. I'm going to notate that information. Taxpayers in a roommate situation pays 50% of standard bills plus all of their own personal bills on their own, right? XYZ, so on and so forth. This is their daughter. They attend this school. They have lived with them 365 days of the year. They provide all of the support for this particular person, so on and so forth. So you've done residency, support, income, and relationship tests. This is my position in regards to this person claiming the head of household status. And you would cite whatever case law that has a precedence in regards to what it is that you're looking for. If you don't know how to look that up, then make sure that you hop into the group because we go over how to research different situations and how to take positions in regards to tax returns, right? Okay, so cautionary advice. Don't recommend a tax position just because it might slip through an audit or gain some leverage. It's about being ethical and not just playing the system. So I wouldn't tell someone to take the Augusta rule who doesn't actually have a room that they can rent in their home just because they got a home. Does that make sense? Okay. So if you're not actually holding the meetings and renting that space for those 14 days, this is not a position that I'm going to allow you to take on this tax return. All right. In simple terms, taking a position on a tax return is about using your expertise to guide your clients through the tax maze. It's not just about the numbers. Okay. So we want to get out of our head that we're just making sure that these numbers are pretty. We're making sure that not just are we bad as hell with our fingers, but we bad as hell with being able to back this up as well. It's you have to understand the rules, the risk, and make sure that you're advocating for your clients in a way that's both smart and ethical. And remember, as tax preparers, we're not just number crunchers, we're literally advisors. That's the difference. Anyone can put some numbers into a system and be able to produce some information, but you being able to explain that tax return, assert your position, cite the reference on why your position will be able to stand up and avoid that audit is what is going to separate you from a tax pro to a tax practitioner, baby. So, moving on, let me tell you what your responsibilities are as a paid tax professional. All right. So, clear communication. You have to lay down the law right at the start. When engaging a client, I'm going to be crystal clear about what I can do for you and what you can expect from our partnership. It's all about transparency and making sure that you're in sync from the very beginning. Two, you're on a fact finding mission. Now, it's not the time to be timid. Prepare to deep dive into your client's tax situation, collecting all of the necessary info. This career path requires more than just gathering data. It's about piecing it together, challenging assumptions, and really understanding and being able to explain the story behind the numbers and support your position. The math has to math, so you got to make it make sense. You also have to learn to apply the law. Once you have all of the facts, it's time to match it up with the tax laws. It's putting a puzzle piece together to see the big picture, the final conclusion, the position that you're taking on the tax return, and being able to let that taxpayer know what they qualify for, whether it's in credits, whether it's in deductions, whether they're going to owe, whether you were able to reduce it, whatever it is, that whatever magic you made happen on that tax return, you have to convey that information to them, but have the tax law and code behind you to be able to back it up. It's also about advising, right? Based on your findings, it's your responsibility to your taxpayer to keep them in the loop about any tax implications of your actions or inactions. This is why having an automation it's set up is so important. I'm not going to remember to call all 215 people that have to file a tax return that's due by March 15th, but I definitely have it triggered to set up an email to remind them, hey, if you don't have these documents to me by XYZ, then you're going to have to file for an extension. And when we file that extension, it's also your responsibility to do XYZ. Okay. And let me tell you why that's going to be important. It's about guiding your client through the maze of potential penalties and interest charges and putting that in writing. The IRS does not deal in he say, she say. Keep complete and accurate records. If you can show the paper trail, you will always what we call CYA. It's also about integrity and fairness. When dealing with the IRS, I recommend that you play it straight. It's all about being honest and upright, not just for the sake of your integrity of this profession, but also your freedom and your bank account. We're not going into 2024 getting 6199s and 6222s and having to pay back thousands of dollars. You know what I mean? For someone that was fly by night, there is so much money that is in this career, but you have to lead with integrity, because one thing about it is that if your name gets out there that you bad and that you putting credits on people's returns and you're taking positions that legally cannot be asserted, you're not going to last long. Not only are you going to have the people that's on the street that owe all this money back on your head, you're also going to have the IRS on your head, and they have made sure to inject the very fair potential. Because before, you had the threat of going to jail, but it was like, you had to pretty much have taken them for like millions of dollars before they was really coming for you. It's a lot more serious than that now. It's like it's stating right out, we gonna give you a year, and this ain't club fed. So make sure that you realize this. You're not going to country club jail for a year, and they want their money back too with their own penalties and interest. And now you don't even have the ability to participate in this career for you to be able to go make the money back. So lead with integrity and lead with lightness profession, right? So let's recap Circular 230. One, Circular 230 is the constitution for tax professionals. It sets the standard for ethical and responsible behavior in tax practice, safeguarding both your rights and mine. The gray areas. Tax preparation isn't always black and white. Sometimes there are gray areas that need careful navigation, and your job is to steer through these ambiguities, always keeping your interest and your client's best interest in mind. Y'all tandem here, okay? In this situation, you guys are going to be partners. So you want to make sure that you're being honest with your client, but you also got to make sure that your client is being honest with you, because both y'all asses is on the line. So documenting your position and recommendation to your client as well as the potential risk, it is not a get out of jail free card. So again, if you think that just by saying, hey, I told them this, but you're still taking this position on the return, go back and look at the penalties and understand that you still are liable. So you want to make sure that when you're signing your number to it and you signing your name, that you understand that you're standing behind everything that goes on that return. And if they find out that you're not signing your number and that you're not signing your name, they still gonna come after you and penalize you. All right. So let's go over responsibilities of a paid tax preparer. When a tricky situation comes up, you got to deep dive to understand what's really going on. You've got to collect all of the necessary information and documents and details, leaving no stone unturned. You also need to research thoroughly and document everything. This isn't just busy work. It's about building a strong foundation for your tax return, right? You have to look at the problem from every possible angle and consider different scenarios and outcomes. So this is not the math problem that's 1 + 1 + 2. It's like 1AB divided by 2AC equals what? There's variables. You want to make sure that you're checking these variables and that you know that all of you know what I mean? You plotting on your graph and you getting stuff together. Ooh, that's sloping wide. I don't miss that. All right. So remember, every decision has consequences. I'll weigh each option carefully, considering how it affects you, me, and my firm. I need to know what you have to mitigate your damages at all times. Whether you're an ERO, whether you're a tax preparer, whether you're the data entry tech, you have to mitigate your damages, because everything is all roads lead back to us as the tax professionals. All right. So keep your clients in the loop at every step and explain the situation, the outcomes, the possibility of the best courses of action. It's all about communication. In the end, the choice we as tax practitioners make needs to be legal, ethical, and in the best interest of who? Us and our clients. All right. So let's talk about engagement, practicing before the IRS. Practicing before the IRS is way more than just filling out tax forms. It's about being a taxpayer's representative in everything tax related. This means preparing and submitting documents on their behalf, talking directly to the IRS, offering them solid tax advice, and standing by their side in meetings and hearings. So this can happen for unenrolled preparers if they're listed as the designee on the return. And they prepared that tax return, then they actually have the ability to be able to defend their position. That's the only way that it happens for unenrolled preparers. Okay. Other than that, you would have to be an EA, a tax attorney, a CPA, and I think I'm missing one more. I can't remember off the top of my head. So yeah, let me just keep going. All right, so it's pretty much the full package. As you're knowing your role as a tax preparer, you're not there just to work the numbers. You're there as your client's frontline advocate and go-to advisor and navigator in the often complex and choppy waters of tax matters. By sticking to the best practices and ethical guidelines laid out in Circular 230, you will always be demonstrating your commitment to handling your client's tax affairs at the highest level of professionalism and attention to detail. You guys, again, you're teaming this together, and literally, I'm just the messenger here to make sure that you sail through your tax pro journey smoothly and effectively. Now, have you heard of the term of practicing before the IRS, right? If you never have heard of it before, these are the guys that are allowed to be able to practice, right? So again, attorneys, certified public accountants, enrolled agents, As tax pros, we have limited representation rights. Enrolled agents, CPAs, and attorneys have unlimited representation rights. So that's the difference between us and them. That's pretty much all that it boils down to. And then the annual filing Caesar program. Okay, it's a program that's for tax preparers who want to up their game. You get listed in the IRS directory, which is like getting a seal of approval. It also gives them limited rights to be able to represent before the IRS. So you have to be able to pass this in order for you to get that ability. You go through 18 hours of training through the regiment each year, including a tax refresher course and studies in ethics. It's like basically like an annual boot camp that just goes over all of the rules that are coming up for the year. But I also like to say you should be taking at least 2 to 3 classes and getting CE credit for those classes on a monthly basis. There's so much to learn that's constantly ever changing in this career that if you're not continuously getting educated, then you will find yourself in groups asking, how do we do this? And how do we do that? And you can't, no one understands and processes information as well as you do. Trust me. Like even me telling it to you is regurgitated in the way for my brain to be able to understand it. So shout out to the people whose brains that think like me, but I still feel like as a tax professional, a tax practitioner, it is our personal responsibility to make sure that we stay up to date and up to code, irregardless to whatever our state says, right? Coming from the state of California, we were required for 20 hours. The first year that I went and got not certified, the first year that I went and got that I went and got my ability to file taxes and I got my CTEC, I had to do 60 hours. You know what I mean? So I'm used to doing, I pretty much on average between about 220, 240 hours a year just in continued education because I like to be big brain about it, right? Okay, so takeaways. I'm going to go ahead and wrap this up and then we're going to get into part 2. So who is your client? There's literally millions of people that turn 18 every year. So the odds of gaining new clientele each year are extremely high. Knowing how to get the information that you need is highly important. Different preparers have different powers and skills, but always remember, tax preparation is just as much about the numbers as it is about sales and customer service. It is a customer service geared career path. So you have to talk to them nice and iron out your niche client. It's like choosing between being a general doctor and a specialist. I understand every client isn't for everybody. You have some people that like the EIC crowd. They want to be able to teach them financial literacy. They want to be able to help them to qualify for the math credits and deductions to get them a nice size refund to be able to carry them and hopefully teach them like how to budget, how to sustain that money, how to invest that money. That may be your calling because for a very long time, that was my calling. And then you get to a point where it's just like, I want to deal with the more high income earners so that I can show them how to build off and capitalize off that extra money that they have, get them into investments and real estate and things of that nature. So that may be your niche. Or you might just be like, you know what? I just want to deal with businesses. I'm a corporate chick. And I like the idea of dealing with high capital and volatile capital. So I'm going to go in and I'm going to do all the S corps. You know what I mean? I want to deal with the fast money. So whatever your niche is, make sure that you dig deep into that and that you have all of the equipment and the knowledge and the tools that you need to be able to cater to that audience like nobody else can. All right. So then you also want to get into the ethics and the legal stuff. All of us tax pros are bound by the rules of Circular 230. Period. Doesn't make a difference whether you're an attorney. Whether you're a tax attorney, a CPA, or an enrolled agent, Circular 230 is the Bible for all of us. So we've got to play by these rules or face the consequences. You have to stay in the know. So if you're preparing taxes, you need to sign up for alerts and take the proper steps to ensure that you are listed on the IRS directory. It's like a nice stamp of approval, but just don't go around calling yourself certified because you're not. Guarantee it. Remember, in the long game, choosing a tax preparer isn't just about being someone who can play with the numbers. It's about understanding your client's unique tax situation and knowing what to do for them and staying sharp and ethical in your own practice. So when onboarding new clientele, think about your ethical responsibilities and your bank account when choosing to take a position on their tax return, okay? All right, that's all I got for now. Stay informed, stay savvy, light and love. And as always, hit that follow button. And if you want to be included in part 2, if you could like and share this video, then I will ensure that I publish part 2 where we're going to talk about the OPR directly on my personal page. All right, y'all.